Let's come back. We're coming to topic 19. In this topic, we're trying to do a comparative analysis in terms of holding returns among China, US, and Japan. We have done a similar analysis, but from a different perspective just now, from periodic return. This time, we do it from investment return. First, let's compare SSE Composite Index with Standard & Poor's 500. Last time, we are doing the comparative analysis using SSE Composite Index with Dow Jones Index. And this time, we change to Standard & Poor's 500. You can change the Standard & Poor's 500 index to Dow Jones Index. Now, this time we do a long-term analysis. The blue solid line represents for Standard & Poor's 500. It represents for the US stock market. And the orange lines is SSE Composite Index. It stands for the China stock market. The date to make this picture is 2021, June 29th. So it is actually end here. It's May 2021. So the analytical period is actually 11.5 years. So it is a really long-term analysis. And in this picture, we have done actually a comparative analysis. We compare two market indexes. And then we also done a trend analysis. Because for any of the curve, we demonstrate this trend, right? Within one picture, we are doing two types of analysis together. In this way, this kind of graph is very, very useful. It's simple, but it can help us to understand many informations about the differences between two market indexes from the perspective of expanding returns. It's actually a holding period returns or an investment returns. Suppose investor invest same dollar amounts in two markets. One is in US market, suppose NYSE. Another is invest in Shanghai Stock Exchange. This is the zero line here. After 11.5 years, what are the results of these two investments? Let's look at the investment in US first. Let's look at its return. Investment return is roughly here. So this is 250. This is 300. Here would be 2075. So here roughly is 280%. And here we have known that its investment return is less than 10%. So if we can turn back our time, we do investment at the beginning of 2010, one in US, one in Shanghai. These are the results of our two investments. One is less than 10%. Another is roughly 280%. So this is the results. And from the shape of the curve, we can also tell that the SSI Composite Index fluctuates around a zero lines, right? Up and down around the zero lines. And for the past 11 years, the investment return of Standard & Poor's 500 is actually in a trend line like this. It's a bull market, lasts for more than 11 years, a 11-year bull market. Of course, for this year, I believe it may be a turning point, turn to bear market, but who knows? We can do a comparison for this year. That's the way we can find from this picture. As for the spread, it's getting bigger and bigger for this past 11 years, but may not be for this year, right? We can do a separate comparative analysis for this year. We will do it later. Next, let's look at the differences of investment return before SSE Composite Index and Nikkei 225. This represents for mainland China. This represents for Japan. We also start from 2010, and here we have is 2021. This we can know. Okay, this is the date we make this table, and this is the zero line as well. This is SSE Composite Index. This one is Nikkei 225. Of course, find that they are significantly different from each other. At the beginning, here, it is about 2013. We find that the investment return of Nikkei 225 went above the zero lines, and since then, it is getting higher in big trends, but it's going down here. Right? It's not going down here. In general, its trend is like this, right? This is its trend. In general, big trends. So from this perspective, we find that the US market and the Japan stock market for the last 11 years has more value propositions, right? That means value proposition usually means for long-term investment is valuable. If no value proposition, that means not valuable for long-term. That also means in that market, probably it's a better idea to do speculative investments. However, for individual investors, it's very difficult to do speculative investments because we don't have the capability, we don't have the skill to do a continuous analysis. But this course, we are learning how to do security investment analysis, right? For ordinary individual investors, they are not skillful to do such a kind of jobs. Well, these are the case script for the pictures we have seen just now. We can replay these cases, but we update the period to this year. Let's look at the situation this year. Now let's do it. We update the period of analysis to this year. We compare the situation between China and US, and also we compare the situation between China and Japan. In terms of investment returns, well, the situation this year is pretty interesting, right? We have SSE Composite Index, China. We have the Standard & Poor 500 Index, stands for USA. And the blue solid lines for S&P 500, and this is for SSE. We find that we have zero line here, both below zero lines. Both below zero line. Both are not good for period of time for investment. However, their trends are not similar to each other, although they are both below zero lines, but trends are different, slightly different. This is the trend for SSE Composite Index. Let's use another way to express the trend of Standard & Poor 500. This is the trend. They're not similar to each other, right? We cannot say which one is better, which one is worse. This is the situation between Standard & Poor 500 and SSE Composite Index in terms of investment returns this year. What about the situation in Japan? This is the situation in Japan. This is for China. And this is for Japan. This is for Nikkei 225. This is for SSE Composite Index. Well, what can we say from this graph? First point is, for the big trends in this period, it looks the same, right? look similar to each other. However, okay, for the trend in this period, still similar to each other, but the trends starting here are different. Okay, so this is the situation. Nevertheless, Japanese stock market is closer to mainland China in terms of geographical distance, so there might be some interactive effects between these two stock markets compared to the one between China and US. So far away. Let's back to slides. We have done the exercise cases together. Now, let's talk about risk. Previous topics, we have talked about the return based on market index. And next, it's time for us to do risk analysis. Usually, whenever you try to understand the situation of a market, I strongly suggest you do both return and risk. You can remember this by the 2R. We can simply call this a 2R analysis. That means return analysis as well as risk analysis. Then we will have a more complete vision on the market. As for the risk analysis here, we have actually 3 different types of risk analysis. First, we have the normal or ordinary periodic risk analysis. For example, annual return volatility. Here, the risk refers to the uncertainty of return. We call actually the risk of return, right? Or the uncertainty of return. So first method, we use a periodic measures. We use annual return volatility. The word volatility in security investment analysis is almost the same meaning as risk, but it focuses on the fluctuations. The risk of fluctuations is volatility, right? The second type of risk we will use here is holding period risk. We have known the holding period return. Well, there is another concept in correspondence. It's called the holding period risk. It's almost the same method. And then we will specially focus on another type of periodic return. We call them investment loss. So why we will spend so much time and energy on investment loss? Because we have a theory that investors are always more sensitive to loss compared to return, right? That's why we need to focus more on analyzing loss. Investment loss. Previously, we already have the investment return. In this term, it is actually a neutral word. We have positive return and negative return. Here we specially call the negative return as investment loss, right? Okay, let's look into the topics. Our topic question, how to describe security market risk of return. What are the differences of market risk return between Shanghai and Shenzhen? Right? Here we are asking the questions for periodic risk of return. We have done the return analysis. Now this time we should do risk analysis. And we still start from comparing Shanghai Stock Exchange and Shenzhen Stock Exchange. Well, this is the picture. Now let's look at this picture. This is SSE Composite Index for Shanghai. And this is Shenzhen Component Index for Shenzhen Stock Exchange, right? And this is the date. Our period actually starting from the beginning of 2020 and ended on July 2021. It's actually the end of June 2021. Here, let's look at the measurement. Here is called the annual return volatility. Once we see the word annual, it means we are using a periodic method. Here is return volatility. Here means risk. That means we are using the method of periodic risk of return to do the comparison, right? This one is Shenzhen. This one is Shanghai. So from this picture, we can quickly have a couple points. The first one was for this period, in terms of annual return volatility, Shenzhen side is higher, is significantly higher, or called consistently higher, right? The second point, the spread is decreasing, or sometimes we say it's shrinking. Third, Shenzhen side, its risk is downward. That's a good point, right? Well, for Shanghai said, it's relatively flat and then downward, then downward. So these informations are apparently very useful if you want to do an investment in these two markets, right? Well, this is the situation before last year and the first half of last year. What will be the situation this year? This year, well, I am not optimistic because we have got lots of useful information from previous studies. However, we want to look at the situation this year. We are still using the Python command compare security. This is for Shenzhen Component Index, and this is for Shanghai Composite Index. And this is the name of the measurement called annual return volatility. Here, I repeat, annual means we are using a periodic method. Here we are doing return analysis, but actually we are doing volatility analysis. The volatility of return, actually it is called, or it is the same as risk of return. Okay, we use RET here to represent the word return. This is the period. Okay, we update the period to this year. Okay, let's do it. Python prompt us an error message saying EOL while scanning string literal. Okay, we see a small symbol here, right? So Python use this symbol to tell us where we have a mistake. Here, yes, we are using a Chinese punctuations here. Let's change it to English punctuations. Okay, what else do we have? Chinese punctuations? No, just one. Let's do it again. Now there are no error message anymore. So using Chinese punctuations, I think it's a bug. It's a bug in Microsoft Office. Whenever we copy the Python command from Jupyter Notebook to Microsoft Office, such as PowerPoint or Word, some of the English punctuations will become Chinese punctuations. So whenever we copy back, it will be an error. Okay, this is the situation this year. We have actually the beginning of 2022. Here we have is about, I think it's about July 21st, at least. And this one is for Shenzhen. This one is for Shanghai. So from periodic risk of return perspective, of course, Shenzhen side is higher this year and Shanghai side is lower. We find that Shenzhen side is much higher, right? It's almost double. So now we have a new idea. In Shenzhen stock market, the market has a much higher risk of return in terms of annual return volatility, right? Okay, now we have a better understanding about the difference between Shenzhen Stock Exchange and Shanghai Stock Exchange, right? Okay, it's back. Yeah, we have a couple of exercise here. Let's look at this exercise. Analyze the risk of market return between Shenzhen Stock Exchange and Hong Kong Stock Exchange by using the SCSE Component Index and Hang Seng Index since 2020. Well, that is very much similar to the exercise case we have done just now. Then this is comparing the SSE Composite Index with Dow Jones. Previously, we have done with Standard & Poor's 500, right? And this is for comparison between SSE Composite Index, stock market, and corporate bond market, right? Corporate bond market. This is the code for corporate bond market. Then this is the stock market using SSE Composite Index with treasury bond markets. Okay, that's pretty much similar to the topic cases, and you can do it yourself. So, previous topic, we have done the analysis by the measurement of periodic risk of return. Now, let's continue to do risk analysis, but this time we employ a new measurement. It's called the risk of holding returns. We still start from the comparative analysis between Shanghai and Shenzhen. The risk of holding returns. We have learned the holding period return before, and the risk of holding period return is actually referring to the uncertainty of holding period return. So this is the risk of holding period return, the uncertainty. Well, we have two topic questions here. Question number one, how to describe security market risk of holding period return or investment return. And question two in this topic is, what are the differences market risk of holding period return or investment return between Shanghai and Shenzhen stock exchanges? So this is our topic case. Well, from this curve, the first time I draw this curve, it made me very impressive. I hope it makes you impressive as well this time. However, it is out of date. So the analytical period in this graph is from the beginning of 2020 until actually the end of June in 2021. It's 1.5 years. And the blue lines, we are using the Shenzhen Component Index. And the orange lines, we are using the SSE Composite Index. So this is the expanded return volatility. So from this, we know that this is holding period return. This is risk, right? The risk of holding period return. At the starting points, they are the same, but as time goes on, first point, both uprise. Both uprise, right? Second point, similar trends. Third point, Shenzhen side higher. Fourth point, spread become bigger and bigger, at least from this graph, right? We don't know the situations after the period. We can do another quick analysis in the same way, but for this year. Yeah. So this is the explanation or the knowledge points in this topic case. Risk of holding returns, expanded return volatility, investment risk, same meaning. Although we have different words for them, but the meaning is the same. Okay, these are the Python commands. I repeat, this is for Shenzhen component index. This is for Shanghai composite index. Now, our measurement is expanded return volatility. And then we can brief it as investment risk or investment loss. Risk of investment loss, right? Okay, then we will update this case study into this year. Well, we can do it together. Yeah. Let's update the period to this year. So before I press the Shift-Enter key, do you have any idea whether we will have an error message or not? Yes, definitely we will have, because I find the Chinese punctuations. I changed these Chinese punctuations to English punctuations. Then there will be no error message, I believe. Here, EM stands for East Money, which is a famous website in China, especially in security investment analysis, right? Well, this is the situation this year. This is the beginning of this year. Here, I believe probably July 21st. This one is for Shenzhen. This one is for Shanghai. Our measurement is expanded return volatility, means risk of investment. Okay. This time is still of risk, investment risk. Not investment loss yet. We find that first points, both uprising, right? Second, similar trend. Third, Shenzhen side higher. Fourth, what about the spread? Spread gradually gets bigger. Small here, bigger here, right? Both uprising. And for the exercise cases, we can compare risk of holding returns between SCSE in Shenzhen with Hong Kong using SCSE component index and Hang Seng index. We can also compare SSE with Standard & Poor's 500. We can compare China with Japan. We can compare stock market with treasury bond market as well. It's pretty similar, right? Now, moves to the third concept of risk. Here we have investment loss. the risk of investment loss. The risk of investment loss, from another perspective, we can understand this concept as the likelihood that we have an investment loss if we invest in this market for this period. The likelihood or the possibilities. Sometimes I like to use the word likelihood because it's a word from statistics. Now, this time we are studying at the risk of investment loss. And we are comparing China with US. Okay, we have two questions here in this topic. So how to describe security market risk of investment loss? Then what are the differences between China and US? So this question is very meaningful to what kind of investors? I believe to conservative investors, because conservative investors focus more on possible investment loss, the risk of investment loss. They are more sensitive to that. While aggressive investors, they are more sensitive to investment return, right? Okay, let's look at this. Well, this picture is also interesting, right? So this is from the second half of 2020. Usually we say this as the second half year of 2020. What about the first half year, H1, until the end of June? That means the first half of 2021. This is 1 year. This is, well, we have, this is the Standard & Poor 500. This is the SSE Composite Index. We have an interesting point here. It is, I believe, end of May or early June. It's an important point that they change their sequence of which one is higher and which one is lower. Before these points, the Shanghai side is higher in terms of annual return Lpsd. Okay, we have learned Lpsd before. It is used to measure the risk of investment return, because Lpsd stands for, again, lower of standard deviation. Let me have a quick review. I believe some of you already forgot. Okay, we have standard deviation, right? So this is the mean of a sample, and the standard deviation may be up and down, up and down, up and down, up and down. These are the observations. However, Lpsd focus more on this part. Lpsd, this is Lpsd. Of course, we have UPSD as well. UPSD focus on another part. That is UPSD, right? So why do we focus on Lpsd rather than UPSD? Because people believe that many investors are more sensitive to loss. That's why we are focusing more on what investors are more sensitive, right? Before this point, Shanghai's side is higher. And after that, Shanghai's side is lower. It's lower, right? This is SSE Composite Index. So what we need to find out is, at the end of May 2021, what happened to Shanghai and US? Why their sequence get reversed? It will be very interesting, right? We probably need analysis on the changes of the microeconomy in these two countries. Well, this is beyond the scope of this course. The market risks, it is the negative volatility risk of the holding returns. This is the case script. This stands for Standard & Poor 500. This one is a new measurement. So this word annual represents for a periodic method, and this one represents for return. Of course, this one is for Lpsd, and this is the period. We can simply update the period to this year, and we can know more about the most recent situation in terms of investment loss risk for the difference between the stock markets in US and China. And similarly, we can do another exercise between Shenzhen stock market and Hong Kong stock market. Yeah. The reason why we do such a kind of an exercise because Shenzhen stock market and Hong Kong stock market are quite close to each other. Okay, very close to each other, less than 50 kilometers between these two. Okay. Now, before we move on, let's have a 10 minutes break.